Why don't we get started? Let me introduce myself before I introduce our panel. I'm Peter Tufano, professor at Harvard Business School and senior advisor at the Salati Institute. And I am particularly thrilled because I've been asking for 3 years to have a panel on insurance at Harvard Climate Week because I think it's super important. But not everybody shares this enthusiasm. So I went on ChatGPT and I asked the simple question, is insurance boring? Right? And ChatGPT's answer was, it depends on how you look at it. So then I said, okay, so like what fraction of people think that insurance is boring? And it cogitated for a little bit, and basically it said, among young people, we think it's 96%, right? And then I said, okay, what fraction of MBAs take jobs in insurance? And it spun a little bit, and it came back and said, well, we don't have much data, but we know that insurance and other finance is about 2%. So it's under 2%. They're wrong. They're all wrong. Insurance is super interesting, super exciting. And if you care about climate, then you care about insurance. And that's what the session's all about. Trying to kind of help you all and all of us get up to speed on insurance. But honestly here, how many of you come in today without a lot of background in insurance? Hands. Okay, the rest of you are not being honest. How many of you think that insurance is somewhat dull? Well, you're here, so you shouldn't think. So we appreciate that some of you will have deep backgrounds in insurance, others will not. And therefore, think of what we're going to do today as something that spans the range between Insurance 101 and a primer to what are the current issues in insurance. And I think if we can succeed at all those levels, then whether you came in with no real understanding of insurance, or whether you came in with an advanced understanding of insurance, you'll walk away kind of being a better place. And hopefully also finding other people who care about this topic. I'm going to keep track of these numbers and tell my colleagues, yes, people do care about insurance. So that's great. So let me introduce, I'll sit down now. I'm going to introduce my panelists. You have on your app, their bios, but I'll just kind of hit the highlights. Immediately to my right is Dave Jones, graduate of the law school and the Kennedy School, who directs the Climate and Risk Initiative at UC Berkeley Center for Law, Energy, and the Environment. He focuses on climate and the link between climate and finance and financial regulation. That's an important role, but perhaps his role before that might have been more, at least as consequential, which is that he was the insurance commissioner for the state of California from 2011 to 2018. Which is the regulator of the largest insurance market in the United States. And he has lots of other backgrounds too. And at California, he pioneered the regulatory best practices to address climate change. So we've got Dave. Next to him is Barney Schauble. Barney's career at Harvard began as an undergraduate. I asked him a little bit about his background, and his undergraduate thesis was with our former colleague, Ken Fruit, on reinsurance markets some time ago.
Way cooler in the 90s.
Way cooler in the 90s, absolutely. And then you could also talk about even cooler things like financial engineering and risk and, cool. Anyway, so Barney has really been in the insurance business in one way or another since then, focusing on reinsurance and cat risk, catastrophe risk. He's principal at Greenthread, a boutique advisory firm, and previously had spent 20 years at Nephila, if I'm pronouncing that right, an asset manager in the insurance-linked securities, or ILS space. And our third panelist is my colleague, Ishita Sen. Ishita is an assistant professor in the finance group at Harvard, and she is an amazing addition to our work here at the university. There's relatively little academic work in insurance, and Ishita is at the forefront of that, looking at questions about how it is that actual insurers set prices, how they might consider other things and when they set those prices, how those prices relate to risk, how it is that risk is borne in the insurance sector, industrial design. And Ishita joined us after getting her doctorate at the London Business School and also working at the Bank of England's Insurance Policy Directorate. So if we think about this panel, they have experience in academia, they have experience in insurance, they have experience in regulation, in capital markets, in regulation. It's a pretty cool panel in order to do the work that we need to do today. So with that, I'm just going to get right started. And I'm going to start with a 101 question. And I think I've cold called Barney to get us started on this one. So Barney, everybody here understands what insurance is basically, which is that there's an event and it happens and therefore you want to get paid for that event. And maybe that they think of auto or life insurance. But the back end, how it is that those promises that insurers make are in any way credible, relies on a business model. It relies on a set of things that probably people don't think about. So can you just help everybody in a couple of minutes understand the business of insurance that backs up those promises? That was a yes. So.
Absolutely. And thanks, Peter. Thanks all of you for joining us here today. We promise this is going to be fun. Your comment on insurance as a word early in my career, I was at Goldman Sachs in a very unusual joint venture trying to explore this whole space. And it was originally called the Insurance Products Group. And nobody's going to want to come and work at the Insurance Products Group. So instead we renamed it Risk Markets. And really, fundamentally, I think that's part of the problem, which is insurance is about risk. I mean, that's really what it fundamentally boils down to. And so if you go back to what is the basic concept, 400 years ago, 5 ships go over the horizon and 4 come back. And people who are in Britain at the time think this is problematic. We don't know whose ship isn't going to come back. Is somebody unlucky? Can we count on these odds? And they decide at that point in time that it's probably better for that risk to fall upon what they described as the shoulders of the many rather than the heads of the few, right? This is how Lloyd's begins. This is how insurance begins. It's about pooling. And pooling works if you believe in the math associated with a large number of independent, small risks. So life, as you say, auto, at least until the Waymo blue screen of death. But generally you have situations where any one auto accident, any one life doesn't really change the overall payout prospects of the pool. You have some trust in the independence of the outcomes. You have some statistics over time. That is true, for example, for houses in cities. So you see the advent of fire insurance. Until partway through the 19th century, an entire city burns down. And in Germany, they think, maybe we need an insurance company for the insurance companies. Maybe we need a backstop to stand behind the fire insurance company that exists in every city. And that's where the idea of reinsurance is born. You may need some backstop for these pools. And that's when that math goes awry, when you have severity or correlation that doesn't behave. It's not about an individual fire in an individual house or neighborhood. It's when the risk becomes too large. And that largely continues to be the case as insurance develops until the 1990s. And you had sort of a similar moment, which is what led to my writing my thesis on this many years ago, which is some events that occurred in the United States at the beginning of the 1990s and the advent of computer modeling revealed there's way more catastrophe risk than people thought, and more than individual insurance companies or even countries in some cases could handle. And so you saw the creation of new reinsurance capital. You saw the creation of the market that I was involved in, which is securitizing and creating financial instruments out of that same risk, what are now catastrophe bonds and weather derivatives. How do you amplify the amount of capital that's brought to bear? And so that's really what stands behind, in many cases, the frontline you see as a homeowner, as a business owner. You're buying a policy from somebody. That policy has to fit into a pool. And that pool is expected to behave in a certain way. And when risks either become more correlated or more frequent or more severe or all of the above, it strains not just the insurance system, but it strains the reinsurance system. And that gets us to where we are today.
Great, thank you. So I know that was quick, but the idea of pooling is central to this. The idea of what can we hold on our balance sheet, what we can lay off to other folks, can we lay off to other insurers, can we lay off to capital markets? There's a lot there. Now, a few years ago, I wrote a case study on the Bank of England stress test for insurers. The Bank of England wanted to understand, would the insurance industry and the banking industry go down in the event of various risks? And this was a climate stress test. Different kind of regulator for sure, Dave, but I'm going to ask you to help us on this one. If you were to step back and say, in what ways does insurance absorb or is affected by and affects climate risk? In your current role at the university and your former role as insurance commissioner, can you just help everybody understand how insurance in 2 ways both affects the climate and is affected by the climate?
Sure. So I think first it's also important to understand there's sort of two sides to the insurance business. There's writing the insurance and trying to make a profit on that. And then there's taking the premium that are collected from us as individuals, families, households, businesses, investing that, reserving that to pay claims, but trying to make money on that as well. And I think there's broad spread agreement, generally speaking, that in terms of climate change and climate risks, that manifests itself in two ways, more broadly in the financial sector, but also particularly for insurance companies. There's physical impacts of climate change, and then there's what's referred to as transition risk. Transition risk is the risk to the value of assets and investments associated with changes in market, changes in technology, changes in policy that drive a transition from one sector of economy to the other. So insurance companies as investors are substantially invested in the real economy, heavily in bonds, but also in common stock, a little bit less in private equities and in venture capital. But one of the transition risks they face is that they could potentially be invested in segments of the economy which ultimately we're going to transition from, and the value of those investments might decline. We saw that in terms of the downgrade of the value of investments in coal enterprises in this country in the aughts and the 2010s when, no pun intended, coal as an asset class dropped like a stone. We had 35 or so coal company bankruptcies. Major U.S. lenders wouldn't invest in coal. And so the value of that asset class declined. And that's something an insurance company, insurance regulator needs to be concerned about, because if the insurance company is invested in assets class that decline in value over time, that has implications for their ability. So that's transition risk, broadly speaking. Then there are the physical impacts of climate change, which manifest in different ways, in different losses for different kinds of insurance companies. Life insurers, if people are going to die faster, that has an implication then for the morbidity and mortality tables life insurers use for purposes of trying to price life insurance. For workers' compensation insurers, if extreme heat results in more injuries at the workplace, that could be more workers' compensation insurance payouts. For health insurers, if people are ill, disease, other impacts on health, that could mean more health insurance payouts. For property and casualty insurers, though, the issue is even more acute because they are insuring properties against the physical impacts of perils. And what's happening is, as global temperatures rise, we're seeing more severe and extreme weather-related events, which are killing more of us, injuring more of us, damaging more property, and causing insurance payouts to go up dramatically. So last year, the insured Nat Cat global losses were about $147 billion all in. The number's slightly different based on your data source, but that is 20% higher than the rolling 10-year average for insured Nat Cat losses.
Nat Cat, you just
Natural catastrophe losses, right? Excluding earthquake, which is not driven by climate change. So the vector is that insurance company losses globally and in this country are going up because of climate change-driven events, and that is a manifestation of the physical impact of climate change on insurance company balance sheets. The physical impacts can also have impact on the investing side of the balance sheet too. Think about, say you were an insurance company invested in PG&E. PG&E started one of the worst wildfires in history in 2018, killed over 90 people, destroyed 18,000 structures, $12 billion in insurance losses. PG&E went bankrupt. The value of their stock and bonds plummeted to zero. That was a challenging investment to hold. So there are manifestations on the investing side of the insurance business balance sheet also with regard to the physical impacts of climate change too that they need to be thinking about.
Great, thank you. And again, we're in the 101 part here, so a little bit more one-on-one, then we'll get to current events. So Barney, you've recently written this really interesting piece with a provocative title, Is the Future Insurable? Talking about this thing called the range of insurability. What do you mean by that? And could you give us a sense of why might the future not be insurable, at least privately insurable?
Sure. So I wrote that piece with a friend of mine, Spencer Glendon, who founded an organization called Probable Futures here in Boston. They are very focused on climate literacy. The climate is changing, here's what that means for you. And many people then ask the question, well, I'm sure the insurance industry is the one that's thinking about this and knows all over it, and therefore I don't need to worry about it. And so he and I have been writing some pieces to say that's logical but wrong, and you do need to think about it. I'm sorely tempted to use the whiteboard, but
Go
that
ahead.
feels very, a little overly 101. So ultimately, again, if you think about insurance, you're thinking about risk and you're thinking about probability. And so if you think about insurance in probability space, only certain things are insurable, right? If you say, I would like to buy protection against the sun coming up every morning, at some point, people say, well, that's certain enough that there's no insurable interest there. There's no prospect there that I will not have to pay you. So anything from up to a coin flip, up to 2/3 of the time, 3/4 of the time, only at a certain low probability is an event actually considered insurable, where somebody else will take that risk from you at a price that you would actually pay. So there's a very broad level of frequency in probability space that's just not insurable. So whether you're talking about a home, or whether you're talking about a business or a country or a reinsurance program, the highest frequency that is insurable is still a pretty low number. Call it 5%, or sorry, 20%, 1 in 5. And even that is going to be expensive. If you want to buy protection against something that happens once every 5 years, you're going to pay a very high premium. So that's what you can think of as the bottom of a layer of insurability in probability space. And there's also a top, which is at some level of probability, you don't trust the estimates of probability anymore. 1 in 100, 1 in 250, 1 in a million, right? As in any asset class, there's only so much that people trust the math as you go out into the tail. But also you run out of capital, right? If you want to buy protection for your house, you may find an insurance company who will do that. You may need to find 2 insurance companies if it's a big house. If it's an office building downtown Boston, which is going to be underwater in 25 years, you may need multiple insurance companies to cover that. And if you look at, for example, what I think is the largest buyer of reinsurance on Earth is a big Japanese agricultural company called Zenkyoren, and they buy about $10 billion of reinsurance every year. And they buy some from everybody on Earth, but at some point they run out, and they don't run out of exposure to the community that they cover in Japan. So there's an upper bound as well. And what we talk about in the paper is, as frequency increases, that lower bound creeps upwards in terms of the dollar of protection that you can get or where you can actually attach that protection. And as severity increases and correlation increase, what you can buy also starts to be impacted. So you're seeing effectively a window or a layer of what is considered insurable being compressed, because more frequent events pushes it upwards, and higher severity and higher correlation means that either you can't get as much probabilistically, or you can't get to the level that you need to get to. So the reason we wrote it was simply to say it's not a question, it's not a binary question. Any insurance decision is a risk management decision. There's an area in which that risk management is executable, and at the moment in the world that we're in, we are shrinking that executable area.
Great. And last 101, which is that, well, Barney talked about this as a market and its distributions. It's actually a regulated market. And I'm going to go back to you, Dave, to give the audience, again, in the spirit of 101, what are the ways that as a regulator you thought about what it was your job to monitor and manage that insurance market? Things like the insurance gap, which, Barney would suggest, I think, that's just natural. There's going to be places that can't get insured, private insurance. So maybe just, orient everybody, and then we'll get to current events, about what does regulation look like in the United States for insurance, and what are the objectives of an insurance regulator?
So unlike any other financial product in the United States, insurance is regulated at the state level. That sort of emerged synergistically in the 19th century and was codified in a federal piece of legislation called the McCarran-Ferguson Act, which says expressly, feds will stay out, states will regulate insurance, unless the feds explicitly enact a law otherwise. So we do have some federal insurance programs, federal crop insurance program, federal flood insurance program, being key exceptions. But every other, the Affordable Care Act being the third. But every other aspect of insurance regulation is done at the state level, and I would say happily so at this moment in our history. So let's talk about property and casualty insurance specifically, because the regulatory authorities that states have granted to their state insurance regulator, typically called an insurance commissioner, differ based on the product line. So we're just going to focus on property and casualty because it's at the sharp end of the spear, if you will, or feeling most acutely the impact of climate change as we've been discussing. So it may surprise you to learn that your state insurance commissioner does not have any authority over the insurance company's decision whether to write or renew property and casualty insurance. That is entirely a decision within the discretion of the insurance company. With minor exceptions, they can't overtly discriminate against protected classes. But other than that, they're free to decide who to insure, whether to renew, whether to write, how much they're going to write. It's all up to them. Some states have granted their insurance regulator authority over rates. Only 15 states have granted authority to the insurance regulator to require the insurance companies to get approval for their rate before it goes into force. And the standard in those state statutes is that a rate should be neither excessive, inadequate, or discriminatory. They can price discriminate. They can't discriminate against protected classes. The other 35 states, 5 territories, and the District of Columbia, carriers file their rates, but there is no approval process for the rate. They're free to use that rate after they file it. And not surprisingly, at this moment, what we're seeing as we see more catastrophic events driven by more severe and extreme weather, driven by global temperature rise, is that insurance companies are responding rationally across the United States with different levels of acuity in 2 ways. One is they're raising price, and that's happening across the United States to varying degrees. And 2, they're increasingly non-renewing insurance contracts, and these are 1-year contracts, remember. They're non-renewing insurance contracts for homes and businesses that are more exposed. In some cases, they're leaving markets entirely. And so that's sort of the state of play, and that's the regulatory apparatus that oversees that.
Great. So at this point, you should be armed. You understand the function of insurance. You understand a little bit about the product set of insurance. You understand that there's a limit to what private insurers will and won't do. You understand that they operate to some degree as private parties, but there's oversight, some more than others. Now let's get to current events. Ishita, you have looked at what's going on in the insurance industry a lot. There's a bunch of different research you can describe. Can you give us a sense of what you're finding? And this now begins the discussion. You know, I have cold called each one of them for the first part. Now we're going to actually mix it up a little bit.
Sure.
So what are you finding when you look at, and by the way, this is mostly going to be about U.S. insurance markets. I'll talk a little bit about international. When you look at, for example, rates across states or some of the other interesting work that you've done.
Sure.
Get us started.
Absolutely. Thank you so much. Can you guys hear me at the back?
Yes.
Okay, perfect. So I am going to talk about the interactions that insurance markets have with mortgages and real estate and housing markets. And just to sort of set the stage, and so we're still a little bit in the 101 space, insurance is absolutely a crucial backbone of the housing sector. So on one hand, of course, there are households that are protected because in the aftermath of a disaster, the insurance company is paying and helping rebuild the house. And so that helps reduce the economic hardships the households face. But also there are sort of 2 important players that hugely benefit from having insurance. And these are the mortgage lenders, as well as the 2 mortgage giants in the US, Fannie Mae and Freddie Mac, who basically ultimately back a vast majority of mortgages in the US. Okay, so how is insurance helpful for these 2 other players? First of all, insurance helps protect the value of the collateral against which they have actually lent money to the households. So in the aftermath of the disaster, since you've rebuilt, you've sort of kept the value of the property intact. And the second very important reason is that households now have less incentives to default on their mortgages if their insurance is reliably paying claims in the aftermath of, imagine a hurricane happens and a wildfire happens and you don't really get money from your insurance company, you're then much more likely we show that you actually end up defaulting on your mortgage. So insurance directly adds to the credit risk of the borrower. Okay, and so like in a world where there would be no insurance, the lenders and the GSEs, Fannie Mae and Freddie Mac, would bear the full brunt of the losses, whereas now insurance companies help actually take the first set of losses. All right, so because of all of this sort of background and how important insurance markets are, mortgage lenders require that you have insurance as a condition to the mortgage. So you actually cannot borrow money for your house if you don't actually take on a property insurance. And not only that, the GSEs, Fannie Mae and Freddie Mac, require that you have really high quality insurance, okay? What does high quality mean? It means that you must be rated at least an A or above by a bunch of different rating agencies. The idea being that if you're an A-rated company, it's less likely that you're going to fail after a big hurricane or a big wildfire. Okay, so with that sort of background, I want to jump to what we, my co-authors, Pari Sastry at Wharton and Anna Maria Tenikijeva at the Fed, find. So what we find, despite having all of these guardrails in place, there's been this dramatic increase in really low-quality insurance companies that have proliferated, particularly in the high-risk parts of the country. So places like Florida, Louisiana, South Carolina, Texas, and so on. And shockingly, in Florida, for example, about 60% of the market are actually backed by these really low quality insurers that are at a very high risk of insolvency. And so much of our research actually tries to understand how did we come to this place? How is it that these insurers became so big? And so I want to highlight sort of two parts of the puzzle. This all sort of started long ago with big nationally diversified insurers exiting the market like Florida after Hurricane Andrew. So it sort of goes back in time. So that's sort of a genesis of that. But the key reason is that the filtering criteria that the GSCs are applying is basically not working very well. So that's basically our core finding. And the reason that filtering mechanism does not work in keeping some of these bad insurers out is because there are these rating agencies that are giving out A ratings, even though any objective sort of analysis of the balance sheet of these low quality insurance companies would suggest that these ratings are extremely, extremely inflated and these insurers are actually at very high risk of insolvency. So that's one part of it. The other part of it is the role of lenders. On one hand, you would think that actually lenders have all the incentives in the world to not take on mortgages backed by these poor quality insurance companies, right? Because that's counterparty risk for them, and they don't want to have anything to do with these mortgages. And they absolutely do that, but they only do that in the loans that they end up retaining on their balance sheet, what are called jumbo mortgages. But there are a bunch of mortgages that they are allowed to actually offload with the GSEs. For these mortgages, their screening criteria, they're not really weeding out all of these mortgages backed by poor quality insurers. And as a result, these insurers have come to dominate the GSE segment of the market with as much as 90% of the market share in Florida, just accounted by these low quality insurers. And so just to wrap up, I wanted to sort of quickly highlight sort of two concerns that you might have. So there is this paradox where on one hand, we have this growing sense that there are parts of the country where risks are effectively becoming uninsurable because correlated losses are becoming more correlated or severity has gone up and so on. On the other hand, you see lots of credit expansion happening in these precise areas, in these high-risk areas. And so the key point that we are making in our research is that basically the signals coming from insurance markets are broken. There's sort of an illusion of reliable insurance when there isn't. And as a result, there are too many mortgages being originated in these high-risk areas backed by these low-quality insurers. And ultimately, it is the GSCs and therefore taxpayers, all of us, that are exposed or bearing the financial burden of backing these mortgages.
So Barney, Dave, reactions, implications. As a capital markets provider, I suspect there's an arbitrage. As a regulator, former regulator, maybe you can just kind of reflect on Ishita's findings and what do you make sense? How do you make sense of them?
Well, I mean, I have just two observations. There are many things that flow out of what Ishita outlined. Probably the two most interesting for this audience are, one is this was designed, right? This is a structure that came out because, as you said, real, if you like, insurance companies, multi-state insurance companies withdrew. One of the reasons that they withdrew is the state itself stepped in and created its own insurance company and its own reinsurance company. Neither of which has any meaningful amount of money, but which provided coverage to citizens. And by the way, this is true in California, this is true in South Carolina, like it's true here in Massachusetts. Most states decided that rather than have an operational marketplace, they were going to expand the residual market to become, in many cases, the largest homeowners company in that state. And one of the ways that that company of sorts funds itself is by assessing all of the other insurance companies in the state when something goes wrong. So even if you decide you're not covering certain properties in any of these states, as long as you continue to do business in that state, you are still on the hook for the decisions of the other people in the state and for supporting this sort of thinly capitalized, not super knowledgeable, very large homeowners company that is in that state. So there's a complicated feedback mechanism here, and this is true in Texas, it's true in California. So that muddies the waters a bit. at each level, you have sort of participants in this risk transfer chain who don't necessarily have real economic interest at heart. And the second observation I would just make is the GSEs go and buy their own effectively reinsurance. They issue bonds, which are called credit risk transfer bonds, into the marketplace. And they buy their own protection against those mortgages going south at incredibly thin coupons, at an incredibly low rates of default. And so unsurprisingly, there are smart people in capital markets now who are saying, well, you just go short those bonds. Like if you believe all of this is going to unravel in a way that seems credible given where climate change is going. But as Ishita eloquently outlined, at every step along the way, the rating agency, the GSE, the people buying the GSE mortgage bonds, you would like to believe as a capital markets participant that somebody is asking the question around like, well, what exactly are these properties? How are they covered? How much are they in harm's way? What's the future trajectory of climate? But in none of those layers. So lots of arbitrage opportunity, but not a ton of great news as citizens of these states or country.
So the only thing I would add to that is what's happening in those states that were identified by Ishita, but in particular Florida. Remember, Texas, Louisiana, Florida, I think there was one other.
South Carolina.
Yeah, South Carolina. It's not an accident that these are conservative states that embrace an ideology of deregulation. And what's happened in Florida in particular is they have deregulated the insurance market. And one of the consequences of that deregulation is allowing a less rigorous rating agency for purposes of ascertaining the financial condition of insurers allowed to sell in Florida, allowing these undercapitalized, largely Florida-based or regionally based insurers to sell in Florida, and then having a construct where the mortgage lenders are rational economic actors and are discerning when mortgages they're lending are actually backed by lower tier, less financially stable insurance, and then offloading those to Fannie Mae and Freddie Mac. But the root cause of the problem, I believe, is deregulation. And there are some who argue that if we just deregulated all insurance markets in the United States, if we got rid of the rate regulation in the 15 states that do it, the world would be just fine. And I point to Florida. Florida has no rate regulation. Rates are 4 times the national average. Insurers are free to charge whatever they want. Florida has the lowest barrier of entry possible with regard to insurance companies writing Florida. Florida set up 2 taxpayer-funded reinsurance facilities. Florida changed the background rule for residual markets, which used to be that if the residual market runs out of money, it surcharges all the member insurers based on their market share. In Florida, the surcharge falls on all policyholders. Basically, Florida's done everything the insurers have asked for and then some. And yet, the major national branded carriers have concluded that the risk of loss and the magnitude of loss in Florida is too high to write insurance. So we are not going to deregulate our way out of this problem. And also I would submit that while there are some things that we can talk about these that you can do in the short or midterm to make insurance more available, in the long term, it's going to be overrun by the increase in severe and extreme weather-related events driven by global temperature rise. And so I believe we are marching towards an uninsurable future. We're running towards an uninsurable future in some parts of this country because we're not dealing with the background underlying fundamental cause, which is climate change.
So let's keep that one on the table for a moment. So Dave's saying unfettered deregulation, that's not going to solve the problem. Why don't you both react to that?
I agree with that. I think it's a combination of, on one hand, I mean, if you sort of think about why Florida had to deregulate, it's because there were no insurers willing to write in that state. And if it had not deregulated, they would have this massive problem where the real estate sector, as well as households, as well as all of the related industries would start to bear the brunt of that. And so that sort of makes sense. I mean, you would want to sort of protect your economy to the extent you can. What that sort of ignores is, in the meanwhile, the mispricing that happens through the insurance markets, through lower prices, or just having the illusion of insurance being available, you're just increasing more and more development in these areas where you probably, at some point, need to put your foot down and say, you're going to build somewhere else. And so the negative consequence of that is it again feeds back to what Barney was saying. We have some limits to diversification, Now we have even more limits to diversification because we've ended up building in the riskiest parts of the country. And so none of that is going to be insurable. So I wouldn't say deregulation is necessarily bad or regulation is necessarily good. I think it's a very complex problem. Whatever worked 30 years ago in trying to sort of strike a balance between affordability, availability, as well as reliability of insurance is no longer working because risks have gone up. And we have to sort of come up with another model, but it is an extremely difficult problem. There are the consequences of deregulation, something I highlighted. But if you also have more regulation, you would have insurers exit your state, something that California has seen happen in the past. And so that also has its effects that we don't want to deal with.
So I think it's important to start with, I guess I would say two things. I mean, the most important piece of this starts with what Ishita outlined. We're operating in a very different world than we were for the last 150 years of insurance in the United States. The presumption of regulators, but also of consumers and of the securitization markets and of all of the other participants in this ecosystem is that insurance is plentiful, right? There's many sellers. It's sort of a commodity good because you can get it every year from lots of players. And therefore regulation was largely designed around protect policyholders against this deep market of people trying to sell them something. And that market was deep because there was a lot of confidence in the underlying statistics around auto and life and fires and homeowners and hurricanes, and you felt like we had a pretty good mathematical understanding of pricing, and it might go up a little one year, it might go down a little, you have entrants come, you have entrants leave, but that there was some stability. You really have to invert that now, right? Now the problem is people can't get coverage. How do you change the regulation of the market and the design of the market to reflect that? Well, one is availability of information, right? If you are at this gathering, you probably know there are many public and private places that you can go to get information about property, both the physical location of the property and the physical parameters of that property, and what is going to change over the next 5, 10, 30 years if you're going to buy a home. But most people who are not being told to look at that information don't have an easy place to get that. If you go to the federal government websites or state websites, a lot of that is obfuscated or removed. Even trying to pass the federal massively money-losing flood insurance program to update their maps to tell people where these are now unsafe places to live has been overruled by Congress, who don't want that because it will cause flood insurance prices to go up. You are not just people staying in harm's way, people are moving to harm's way because they're not getting the information that they need. And then it's also no term structure in that market. You can only buy a one-year policy. And again, that makes sense when you think, well, next year there might be a better offer. Next year I might move. Or next year I want. But if you have a 30-year mortgage or a 10-year loan for the building that you're building, or you just want better information saying, well, what would a 2-year price be, or a 5-year price be, or a 10-year price be, like you can for a mortgage or for many other hedging and risk management products, would give you information about the trajectory of risk. And that's entirely missing right now. And so really, if you invert sort of the classical assumptions around, there's many insurers, they're all happy to sell you stuff, and say, how do we actually treat this as a risk problem rather than kind of a boring line item on my spreadsheet, which is I have to buy insurance and I guess I will and I'll buy it again next year. I think, what risk do I want? Maybe I want to buy a 10-year insurance policy. I know it will be more expensive. If I sell the house, the policy will stay with the house. That becomes an asset that helps protect my value. You have to envision what a real market would look like, because right now it's not a real market. And by the way, the last piece of that is don't have the state be in the business of selling insurance in every single one of these coastal states, because that really does occlude the marketplace, right? It's one thing to say there are certain buyers who can't find it and you're a residual market and you cover 1 or 2 or 3% of the market. But to be 20% or 40% of the homeowners market, by a company that is not really operating with the best of knowledge or the best of intentions also changes the marketplace. So I think there are things you could do, but those are big changes.
So this has now gone to a dark place. So let's in our last 5 minutes, thank you. What can be done in the small and the large? So, for example, zoning laws that say you can't build a building there, but also building codes, fortified things, which those words don't mean much to other folks, but maybe Dave, you can articulate a little bit about that. Or collaborative action in the insurance industry, as they have done, a few times in the last century. So what are possible, I wouldn't say macro fixes because the macro environment is so complicated here. What are some micro, at least, things that might release some of the pressure and tension and risk in the system?
So I'll start. One, accelerate the transition to net zero across the whole economy. Insurers can help with that. They have over $500 billion invested in oil and gas. They should be asked to transition out of those investments and asked to transition out of writing insurance for the very industry whose emissions are the principal driver of the global temperature rise that's causing the losses, that's causing them to have to say to states they can't write insurance. Insurers can't solve this alone, though. I think we need improved building codes that take into account the best science with regard to resilience and adaptation. I think we need to dramatically change zoning state by state in this country so that we're not encouraging development. In fact, we're restricting development in high-risk areas. I think we need substantial federal, state, and local public investments in adaptation and resilience at the property, community, and landscape scale. The industry has come together through the Insurance Business and Home Safety Institute. They've come up with a standard for home hardening for wind, hail, severe rain, and wildfire, but it's expensive to meet that standard. The public sector, through local, state, and federal funding, needs to help people harden their homes against these perils. Landscape scale mitigation also works as well. Spent a couple of years at the Nature Conservancy demonstrating that insurers can, their models are able to account for landscape scale forest treatment. Thinning, prescribed fire, nature-based, not clear cutting, reduces the fuel load in our western forests and our southeastern forests, demonstrably reduces wildfire risk, can be accounted for insurance models. They ought to take into account. And I guess that leads me to my final point, which is that there are investments in adaptation occurring at the property, community, and landscape scale currently. The insurers are not accounting for it in the models they use for pricing or underwriting. On the pricing side, a couple states have required them. Alabama says if you do a fortified home roof for wind, you get a discount. California says if you do fortified home for wildfire, you get a discount. Discount doesn't matter, as Barney said, if they won't write you the insurance, right? And that's where we are. So we need the models they use to decide whether to write and renew the insurance, also to take account proven, empirically based, scientifically based mitigation at the property, community, and landscape scale. Insurers aren't doing that. They can do it. A project that I led with Willis Towers Watson, the Nature Conservancy, we placed an insurance product for a 6,500 homeowners association smack in the middle of Northern California. Based on their forest treatment, the insurer was willing to write, where other insurers are pulling out. So this can be done. Insurers can and should do it. They're not doing it. If they won't do it, then the solution is require them to do it. Colorado just enacted a law this year, HB 1182. They got tired of waiting around for the insurers to voluntarily take up into their models all of the investments in mitigation. Now, as a law in Colorado going forward, July 1st, 2026, the models insurers use for pricing and underwriting will have to account for property, community, and landscape scale mitigation. My hope is the insurers do it voluntarily, but if they don't, there's also a state policy path to require it.
Barney, Ishita, what would you do at this point, kind of small to medium-sized things, other than re-engineer the entire financial system in insurance?
I agree with basically everything Dave said, except two things. One, it's hard to imagine insurers sometimes passing on these discounts to households when in many states they can't get the rates that they want. And so often that is one reason, you don't see insurers giving full credit to households for any mitigation that they might do. That's a small point. I agree with everything Dave said. I would just say basically resilience investments in making your houses more resilient, hardening your homes. We need to reduce risks. That is sort of the starting point, as Barney said. We have sort of come to that point of the distribution where there is really not that much we can do unless we sort of try to go back and reduce risks. And I would also add to that, not only do we need to actually harden our homes, but also harden our financial institutions. So that was sort of the point that I was making. We need to have them hold enough capital. We need to have them be diversified so that one big hurricane does not blow them away.
Last word, Barney.
So, insurance has to change from being sort of a boring specialty that you don't really need to think about to being a risk problem. It's going to get a lot more exciting in the insurance world that you all interact with in the next 5 years, right? It is going to become a topic that, and I proudly received my non-renewal letter from my insurance company for my house in California right before I flew out here. So, this is, hey, I should have just handed it out to people. But the fact of the matter is, this is not, if something cannot go on forever, then it will stop. And this is the case. The insurance market is about to become not a boring topic. But what all of you can do, and what I think is fundamentally missing, is not what a regulator can do, and not just what academics or practitioners can do, but as an investor, as a community member, as a homeowner or a building owner, start asking questions. Can I get coverage for 5 years? What do you think is going to happen to this building over the course of the next 2 to 10 years? Whether it's your house, whether it's a house you think you're leaving to your children, whether it's a office building that you're building for reasons that remain unclear to me in the Seaport. I grew up here. I grew up on the South Shore. I remember what that used to look like. That's all going away, right? So the fact of the matter is people are not asking questions about the future. And if you don't ask questions about the future and you don't think of this as a risk problem and it remains the domain of a bunch of specialists, it's unlikely then to lead to real change. And the change is coming. It's just a question of do we all want to see the change and talk about the change? Or do we want to just not think about it until the consequences are much more dramatic?
And I think that's a great way to end. We all have to ask questions. And that's what we're trying to do in academia and in work that you're all doing. We're trying to ask questions about how this system works at the micro level, at the meso level, at the macro level. And therefore, this thing called insurance, not deadly dull, super interesting, a little frightening. Because at the end of the day, even though folks in some cities might say there's no such thing as climate change and this is a hoax or it's just a hot summer, I think that's a quote from the senator, we understand that this phenomenon is not going away, the fundamental science isn't going away, and the risk is going to have to be borne in part by this private sector solution called insurance, in part by the government, and in the absence of that, by all of us. So I hope you found this interesting and informative, maybe a bit scary. We will put links to various papers, Barney's papers, Ishita's papers, up so that you can kind of read more. But thank you for making the choice. You're more than 2% of our audience today to this session on insurance. Thank you all.